How's it going, guys? Welcome back to mentfx, and in this video today I want to talk about something that a lot of you might have not been doing or thinking about when it comes to Wyckoff. So as a lot of you know by now, and let's just zoom out for a second and look at this. I'm sorry, I got this crypto open. I was looking at some random shifts. I don't even know. I was looking at some random stuff and there was a great opportunity. But honestly, we'll keep ourselves on this because it actually does play into what I want to talk about today with you guys. But ultimately, what we understand is that as price moves and creates structural points within price, right? So as it creates breaks of structures and as it creates areas where you can expect liquidity to basically rest at to continue running new highs. Why? Because above these certain swing highs rest buy stops, right? So more like stop losses and people that want to buy, but ultimately the same thing. So we just think about liquidity or areas above swing highs as areas with buy stops and areas below swing lows as sell stops. And again, just because both of them have liquidity resting above and below the price action, we utilize the way price is moving and breaking structure from certain areas to determine which liquidity points are more likely to be ran first, right? So something that I touch on in the mentorship a lot, and something I'll touch on with you guys here that I think is really important, is to constantly be in the nose or asking yourself which area, the high or the low in a certain range, is more likely to be attacked first. If we're in a range like this and this range has been created by this impulse right here, which has come from breaking this previous impulsive high, then we know that this impulse is more likely than not, whether price is here or if price comes all the way down into here, even does all this, right? If price is doing all this, we still, under a probabilistic mindset, expect the liquidity or the sell stops above the swing highs to be tapped before, this would be tap one, before the sell stops below the swing low were to be tapped. This is kind of the idea of a very simple bullish or bearish market. So very quickly, again, this is a very random pair as you can technically consider, but the reason I bring it up to you is because I want to kind of look at this exact same prospect in this price action here. Okay, so before we go into all the other stuff and the fractal nature of it, and again, if you haven't seen my prior video where I'm basically on a 15-second chart, just kind of charting up the market and saying, okay, based on where we are, we can expect, pullbacks, and based on where we are, we can expect to take short-term sells right now into the sells down here, right? Things like that. That specific video was to deal a lot with the idea of structure and how we basically take large structure and continuations in structure and partner it with the idea of lower time frame structure. And again, all of that is grounded in the same idea that if we have a bullish structure unfolding on any time frame like this, all we expect is the pullbacks that will come to grab the orders resting inside of the demand zones, in this case, in these areas. Why are there demand zones here that price will want to reach for? Sometimes you can, again, refine it to a certain area, because these areas here are the unmitigated or the price action that was left behind inefficiently from when there were sells into the buys on behalf of smart money. So again, we are putting together a few concepts here of supply and demand, of orders being put into the market, of liquidity being created, and order flow holding, right? So even in structure, the reason structure holds in some areas and on specific time frames for a while is because what's happening is on a very low time frame or on a very low basis, or in some cases, if we're on, for instance, a daily chart. So if we just go here, we just open up some kind of daily chart. If we're on a If we're on a daily chart, the reason that long-term highs can hold, so for instance, without going too far into the prior price action there, if we're just looking at this, the reason that we have these main points in price holding was because during this entire point here, right? So forget that this came higher, forget that inside of here there was also different structure. The fact that these specific daily highs right here, 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 and here, and in this, just these four basically held, was because they were being protected by smart money as they began to distribute into prices, right? They distributed into them, continue to distribute how? With distributions within supply zones. How'd they continue to distribute? With distributions in supply zones. How'd they continue to distribute? With distributions, right? With the runs of highs, the transfer of weak to strong hands in some kind of inefficient zones, right? So you can look at imbalances here, or you could have maybe looked for price to come higher, and all the way down distributions inside of supply zones, so on and so forth, until we finally had that shift in momentum. And you know, even though this might not be the real shift, when we see a break of structure of this nature that comes to take out the protected that comes to basically take out the protected swings along the way down, we anticipate that there is more likely than not a complete shift in what institutions may be doing with the market. So as that happens, our anticipation instantly goes from seeing these highs protected, right, as a form of continuous bearish delivery, to, oh, we've undergone proper accumulation and we're ready for an accumulation that will now probably come to run the highs that were previously protected. Why? Because there's no reason for smart money or the institutions that were protecting them before to continue to protect them now. So as a result, we start to take the areas of demand in, so you can take, you know, a few areas of demand here that you could have actually found, and you can go and refine them better. But now you look at few areas of demands inside of the ranges that are being created, and you again ask yourself the question, based on the fact that we had this large structural shift right here and this break of structure higher, right here, and we all understand that above here is going to be liquidity on the top side in the form of buy stops, and here on the bottom is going to be liquidity on the sell side in the form of sell stops. Now, which liquidity is more prone to be attacked? Ever since this high was made here, we actually sent out a bullish bias and basically said, you know, look for the pullback, look for the continuation up. Even when price was here, I was looking for buys. We caught buys inside of this, then they got liquidated by this move here. And even after those buys came to be break even or whatever, it didn't stop us from changing our bias to go bearish, because we still understood that our overall higher time frame in this case is still delivering a bullish price action. And therefore, we are still looking for, until basically this liquidity gets tapped out, for this high to get cleared, this high to get cleared, and potentially even the highs here to get cleared. And potentially, you know, you can go further out and say the highs here to be cleared, and maybe we begin to have a real run back up into some of the supply zones up here, right? So that could be very long term. But again, this basis is rooted in the fact that we had protected areas that were being distributed into, right, with Wyckoff distributions, right? And if you haven't seen my prior videos, the snowflake rule is basically the fact that Wyckoff can deliver itself to you in a number of ways. But of course, there's Wyckoff here, there's Wyckoff here, there's Wyckoff in here as an accumulation, then Wyckoff in here as a redistribution, then another mini distribution inside that redistribution, right? Then finally an accumulation, right? There's tons of Wyckoff undergoing in these areas. You can't just fully just trade Wyckoff because of this reason, but understanding where you are structurally, understanding where you are on a higher and lower time frame structurally, understanding which supply and demand zones you want to run, and understanding where you are in a range and which liquidity wants to be ran, either using the notion of we've just completed a markdown and we're starting a markup, so we want to run highs, 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 or of course bringing out the VPVR and understanding that at the lowest areas of at the lowest nodes in price, which basically exist right around here, and here, we understand that basically anything below that is liquidity. So even though these areas here had, you know, you could argue a ton of orders that might be protected, they might be protected short term, but more likely than not, you would see those ran if we do remain this bullish bias. So under this premise, the reason I bring this to your attention is because you guys need to start to think about, even though there's liquidity on both sides of the market, at highs and lows, at almost any swing high and any swing low, under the way that we trade the market or understand it. Even though that's true, you need to understand, based on where you are and how price is moving towards certain areas, which area is more likely than not going to be cleared, right? So at this even specific point, is it more likely, for instance, that price is going to clear the liquidity inside of, so this is all cleared inside of here, right? So I'm just looking at these little swing highs, or the liquidity here. Now, even though price is closer here, it's probably more likely to clear this liquidity first, right? Only because we've already put in a potential bullish bias within a prior bullish bias, and what appears to be a good accumulation, which also tested the last demand zones and imbalances created by the last sell to buy candles in the overall markup that displaced price and began to take it higher. So under that premise, we again go back and say, okay, based on that, which liquidity is more likely to be ran? And then we look for that liquidity to be ran, right? The reason that I want to kind of make this video and I kind of want to get to you guys is to show you again that Wyckoff isn't here to tell you exactly where price is going. If you had a bearish bias, you could have been looking at this as a distribution and this as a potential UTAD right here, right before this happened. And honestly, even I might have been looking at that. But when you see price come and fail to break structure and give you a real sign of weakness and begin to put in lower price action, you begin to anticipate the markups. And as this begins to unfold to the top side, then you are able to catch the intraday movements of that to the top side within it. Now, again, that comes with confirming and understanding what your Wyckoffs are going to look like. Impulsive Wyckoffs, right? Whether it's wick breaks or candle breaks, it really doesn't matter, right? What matters is understanding where you are in a location and understanding how price can get to the next specific location, right? So just looking at UCHF right now, we basically are under the assumption already, based on the way that it's moving, based on the way that it's displaced price. And again, I could be wrong, but that won't matter because we confirm our bias, and our bias is flexible and able to be changed. A lot of you need to recognize that creating a bias and understanding and basically deciding what you want to do with the market if you are presented a certain number of factors is exactly that. It's a bias that can literally work 5% of the time. Now, 5% of the time that your bias does work, if price delivers to you in a way that gives you the opportunity to see the transfer of weak to strong hands in areas you expected that to happen, then your bias is ready to play out. So in my previous video where I looked at a 15-second chart and traded like 8 different markets and just kind of entered based on structure, what I was showing you guys is a formulation of very short-term bias and a sticking to that bias until invalidation. Now, the ones that did invalidate, we got out of. The ones that did not invalidate were profitable, and the ones that began to invalidate further up, we began to manage at break even, at partials. So if you haven't seen that video, please check it out. It's a very short video, but it does a lot to show you to show you a little bit about what I'm trying to basically get over to you guys. So again, what you're seeing on almost anything, so we'll go back to that crypto example really quickly. It was just over the weekend, so it wasn't anything crazy. We'll go take a look at what's going on here. Let's go to a lower time frame, right? So what we were talking about basically, and what I want you guys to take out of this is that when you have a certain bias printed and you have a certain number of higher highs, higher lows or whatever, and structures being delivered to you on a specific time frame, because remember, based on the time frame you're looking at, you are going to see different structure. You're going to see bearishness on a higher time frame, bearishness on a lower time frame, the bullishness that's meeting that bearishness on an even lower time frame, the bearishness that's meeting itself with bullishness to meet the bearishness on an even lower time frame, and so on and so forth. So there's going to be delivery of price that is constantly fluctuating. Now, all you need to do is spot one fluctuation in price that you understand can complete to a certain point, such as, right, and we're going to look at this right here. So we have SHIB Tether US. I honestly don't even know what this is. SHIB, it's literally SHIB. I don't know what that is. It's a crypto, but it doesn't matter. If it's available to be traded, fantastic. It's a market that's worthwhile, okay? It won't be available on my prop firm, sadly. It's probably going to be a lot more Forex based, but definitely stay posted for the announcements on the prop firm because there will be a lot of giveaways since we do have the YouTube for you guys, and a lot of you will be able to get some free large accounts to start trading with. So that's going to be really fun. Now, why was this bias created and why was it met, and how is it important, and why is it important to understand where you are in a given price and then basically just execute upon it? So like we said here, you have, if price action is doing all this consolidation in here, it doesn't really matter. Understanding where you were in your bias prior and understanding why you came to tap this area or why it's coming to tap this area now still will lead you to believe that this liquidity is more likely to be cleared before this liquidity. Why? Because if it's true that smart money is continuously accumulating positions and continuing to the top side and breaking structure, then it's true that the liquidity above, aka the sell stops above those liquidity points, are going to be ran. And to run them means that sometimes we'll have to undergo very long-term accumulation, which might look like a very, very shitty snowflake, which is somewhat normal, right? That's fine. Wyckoff does not have to deliver like this to you guys, okay? If you go to a chart and see this, it's great Wyckoff, and there you go. That will get you involved in great trades. And if you only trade this, then sometimes you'll stay out of like really good trades because you're just looking for this. Now, if you did look for something like this constantly, you could make an entire system out of trading just Wyckoff like this. But the reality of Wyckoff and the way we teach it, especially in the mentorship, is to understand it more so as a weak to strong hand transfer rather than a specific schematic that has to look a certain way that follows specific principles. Now, there are some principles of a schematic that make it more valid than others. There are practices within a schematic, such as looking at certain points within it, like the spring and seeing how price moves there, that allows you to confirm it. Seeing where the spring hits or refining a zone is also very important too. That's covered in the mentorship. If you want a piece of that, launchpass.com/mentfx. It's the link in the description. So make sure you check that out. Otherwise, stick to the free stuff and go and study the schematics yourself. You can learn all this on your own as well. It's out there for you. But if you want a community, you can. So, under the premise that we were just talking about, why was it that I was looking for this right here to occur? Now, very quickly, ask yourself what it is that this price is doing. Already, without even going to higher time frames, you can notice that we have this very large displacement of price upwards right here. Now, this displacement of price right here, okay, even though it's a bullish structure, we need to understand where we are on a higher time frame, which we won't deal with right now, but this ultimately right here is a breakout structure to the top side. And under this premise right here, we basically go into it thinking that this area right here, as a form of liquidity, is going to be cleared before the low down here, right? Now, that's not always the case. You can see my bias was still looking to take out the liquidity here. And there are reasons for that, right? If we zoom further out, you will see there are reasons that supersede this bullish structure. Why? Because this bullish structure right here, right, was part of what? The bearish structure right here. This bearish structure down that unfolded and created this low, created a liquidity low right here, right? This is a liquidity low where under is going to be a ton of what? Sell stops, and a liquidity high. And under that same supposition, we will approach this market with the consideration that we are more likely to run the liquidity here before we are ever to run the liquidity here, right? So under that, and seeing that this is coming to test the the supply zones that are up within this structural point, we now, instead of looking at this break here to continue higher, look at this break here as a fake grab of liquidity to actually continue lower, okay? So again, this is why the previous video is actually very important if you have not seen it. And also for anyone that's still here, we are going to actually that'll be the website. We're going to actually do the giveaway right now. So what is it? YouTube giveaway random. Let's go find YouTube comment picker. So let's go find my YouTube. Pick a winner. Yes, perfect. Let's go find the video. So it's under structural analysis. We're gonna paste that in right here. We're gonna filter duplicate, include replies based on specific text, and the text is #mentfx. So we're gonna get the YouTube comments really quickly. This is for the 1 hour one-on-one giveaway. I think this is the right one. So yeah, only a few of you got to see it because if you watched the video through, you actually had a chance to spot that we were doing this giveaway. Awesome to have 233 of you in here. Let's go ahead and run the numbers on that and start. So the winner of the 1 hour one-on-one with me is Mia Prezel. So I'm sorry if I screwed up that name. Great con as always. Thank you. I appreciate that a lot, man. Thank you very much. Please reach out to me on Instagram with proof of this. So as you know, you have to follow me on Instagram. It's @mentfx. So go and follow me on Instagram and just reach out to me with your account information just to show me that it's you. And I'll be glad to set up that one-on-one with you. Now, back to what we're looking at here. Again, all you need is a short-term bias. What do I mean by that? Now, as price is basically delivering lower, you can see all of these structural points, and these structural points exist on higher timeframes, right? So if we switch between timeframes, you are going to see these structural points here, right? So you can see the low, the high, the lower low, and what do we expect? Potentially a lower high and a lower low, right? So you can see that that was the expectation at the time of. I actually had that expectation to keep delivering price lower. Okay, so that was actually something that I was wrong about, but still made money on. Now, why? Let's think about it. So on a lower time frame, if you go ahead and begin to refine some of the zones in here, which I'm not going to get into, but pay attention to this zone right here. That's ultimately what I was targeting. I don't know why this is all the way up there. I think it was something like that. So again, pay attention to why. I mean, a lot of you understand a wick on a lower time frame, right, is nothing more than, if we zoomed in on this price action, it's going to look like this, right? On a lower time frame, a big up candle, a down candle, a creation of a supply zone, and the move away. So inside of there is going to be imbalance. There's going to be a buy before a sell, and that buy before the sell, as you all can see, took out all the liquidity above these highs, and after liquidating them, took it lower and never really tested the zone up here. So my bias, even though I wanted to see this low cleared, I wanted to see it reach up into the areas up here before delivering a price lower. Now, why is that important? The reason that's important is because as price gets to these lows without taking out more lows, so actually you can see that this low right here got taken out, but this low right here did not. So let's get rid of this line. I'm sorry. Here we go. Okay, so what you'll see is the line right here at this very, very low got taken out by, I think, like half a pip or like whatever this is. Like you can see if I make it perfect, just a little bit under, or even perfect. Either way, that's not what matters here. What matters is as we came to make this low, that was close or whatever it was, and made the equal lows, we shifted higher. And this shift higher right here, so let's get rid of those. This shift higher right here was met after equal lows were created, equal lows were created, equal lows were created, lows were created, and all were taken out. Now, after those takeouts, what did we see? Did price kind of slowly make its way back up? No. It impulsively moved and broke basically all the structures that was inside of this push down, right? So the structure here, 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 and here. So these are all structures on lower time frames. And what does this mean, right? Remember what we just spoke about with protected highs, and as we shift, we see all those highs become non-protected. That's what's happening here. On a lower time frame, even algorithmically, you have protected highs at all these areas until price finally shifts. And as it shifts, what does it want to attack? All these protected highs. And as it does that, it comes to come and liquidate all of them, but also puts in motion a short-term shift in institutional structure to the top side. Now, again, does not matter what time frame you're looking at. Cover this, make it a 5-month if you want, right? A 5-month chart will move the exact same way. And after that happens, what do we begin to anticipate? As you can see here, the anticipation was actually to come and see the tests of the last demand zones in here, which, by the way, if you refined, I didn't refine, I just kind of took a general area. But if you refine to that last wick down before the move up, then of course you had a beautiful entry that ran like 1 to 6. That's not what happened to me. So we'll go back up to where we were. I think it was around there. Very, very simple entry at around a 1 to 2.55, and I was actually only targeting this liquidity. Why? Because in the case that this is shifting, again, the same thing. If this is shifting to the last protected high, which is seen by this bearish structure right here, right, and that's shifting it, what does that mean about the highs here and the highs here? That those previously protected algorithmic highs are now going to be ran. And that's the bias that we were functioning under. And under that short-term bias shift that's based on, you could argue the 4-hour chart into the 1-hour chart, and the 15 into the 5-minute, into the 3-minute, or whatever it was, right? Based on all these shifts in price, the short-term bias that we needed to create a profitable situation out of this move was this break of structure right here after this Wyckoffian accumulation. And after that accumulation, and we see that shift in that structure, we know that the next most probable and likely move is to come and attack the protected highs that were previously used to distribute price lower on a lower time frame, right? Distribution. Now were previously used to distribute price lower into now being an area where we can look for accumulation to come and take out those highs. So why was I targeting this liquidity and a little bit above it? Because I understood this is the buy stops that now need to be ran, and that's what got ran. Now again, some buy stops did great on it and they come up way higher, and the reason they did was because they were looking for some of the so I'll actually show you right here, looking for some of the supply zones in this larger structural leg. And I was not a participant of this. I didn't see it. I missed it, basically. But either way, we again can formulate that short-term bias off of what price could deliver to us using nothing more but the understanding that if we have certain structural points hold, we've created protected lows. And in the case that those protected lows begin to fully shift, right? In the case that those protected lows begin to shift, we start to anticipate the run on the new, on the previously protected lower highs that are no longer protected. Why? Because if there's a shift, smart money has begun to basically get rid of all their distributed positions and have begun to really accumulate. And this whole thing here becomes a large accumulation, which then begins, it can take a while, but it should never get below, but it should never, there's a shift. And it can do all this for a while, right? It can do like this type of thing. But what's going to happen is it should never get below here. Why? Because that becomes a new protected low. We begin to put in motion a new structural play. And now as those protected lows are put in place, we now begin an accumulation cycle to come and run liquidity, 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 which previously functioned as protected lower highs. So remember, just because a protected lower high or a lower low is protected, you know, in the past, by no means it's going to be protected in the future. And a short-term bias of a short-term shift and a short-term understanding of where you can get involved to start targeting that specific liquidity is how we look to get involved in this market. And then partnering that with the other things that is available on this channel and in the mentorship, you can create some very nice scenarios for yourself and create an overall refined system that you can trade. Thank you very much, everybody. I hope this video helped some of you. I know I haven't been uploading a lot. I'm very sorry for that. Please reach out to me if you won that one-on-one. Otherwise, stay posted for the prop firms that are coming up. Stay posted for the content that I have planned for you guys. And thank you so much for almost 30,000 subscribers. You guys have been fucking amazing. And if you made it this far, I hope you guys have a very profitable week, a profitable month, a profitable year. And I hope you guys are learning on your what is it? Oh yeah, I hope your journey is full of learning from me. I hope I basically am able to help a lot of you. I know I've seen a lot of great comments and everything. Thank you big time. I know some of you did not like the previous video on the 15-second structure where I was just entering 15-second charts. But again, the reason for that and the reason that I wanted to release that to you was to show you the importance in understanding short-term structure or even long-term structure and viewing it from a fractal perspective to understand the most probable and likely move, because this market is nothing more than your ability to determine the most probable and likely move and trade that move. Thank you very much, guys, and I will see you in the next video.